What up, HyperChange? Welcome to another episode of Moonshot Monday. Today we're making a special episode for Mr. Warren Buffett. First, we wanted to say that you're a huge inspiration and idol of ours, and a big reason why me and Kevin are so passionate about the stock market, and even a reason why we created HyperChange. So thank you. I was watching the Berkshire shareholder meeting last week, streaming it live. It's an incredible event as ever, and I noticed that you acknowledged the risk of both self-driving cars and self-driving trucks to several of Berkshire's businesses. This got me thinking, how big of an impact will a successful evolution of Tesla's business model have on Berkshire Hathaway? So, we got our hands dirty, we opened the 10K. Today we're gonna tell you about what we found. Bear with us, we wrote this down because it's complicated. The first line of Berkshire's income statement is insurance premium earned. These represent about $46 billion of Berkshire's $233 billion of 2016 annual revenue, approximately 21% of the total of Berkshire sales. And of that $46 billion in insurance premiums earned, about half of them, 56% to be exact, is related to Geico, whose main business is car insurance. That means, in total, about 11% of the entire revenue of Berkshire is correlated to Geico's insurance premiums earned. Why is this an issue? I guess we'll let you tell the people, Mr. Buffett.
Self-driving cars will be adopted if they're safer. If they're safer, there's less in the way of insurance costs. That brings down premium volume significantly. So if the day comes when a significant portion of the cars on the road are autonomous, it will hurt Geico's business very significantly.
And although you may think it's 10 years away for full autonomy, that's not going to be the start of the impact on Geico's business model. We think the impact is going to start happening right now. In fact, Tesla's already began offering its own insurance product because of their new autopilot features. Their cars are much safer than anything else on the road. Legacy insurance companies are slow to react to this and adjust the rates. Therefore, Tesla had to step in and create their own customized insurance product to accurately reflect the risk and safety of their vehicles. Tesla's vehicles are only getting safer by the day as the company continues to invest in its autopilot and autonomous driving software, and even if the car is never fully autonomous, even partial autonomy could result in as much as a 90% improvement in safety, or 10x according to Elon Musk. This would be enough to flip the entire economics of insurance on their head. So we think that Geico is at massive risk to lose almost the entirety of its business as the entire auto insurance market shrinks drastically with the advent of self-driving cars. So that's why I'm curious of Mr. Buffett, what is your strategy around this other than just waiting and thinking that it's not going to happen for 10 years? Because even then, you're a long-term investor who should be looking through the lens of decades. And if you look in through the lens of decades, self-driving cars and autonomy seems like an inevitability and something that you should be preparing your businesses for. Sales and service revenue. This was about $119 billion of Berkshire's $233 billion in revenue, or approximately 51% of your revenue in 2016. Of that $119 billion, $48 billion of it is from a trucking company called Mclan that you acquired from Walmart in 2003. Now, Mclan operates a massive fleet of over 3,700 tractors that are delivering products and goods all over the country to different retailers and distributions like grocery stores, delis, all that kind of thing. And we think that's an excellent business, but that is exactly the business line that Tesla's coming after with its Semi. Now, there is a strong possibility that Mclan would be a customer of Tesla and purchase a significant amount of Tesla's new semi-truck and begin integrating it into its fleet if it really is more cost efficient. The other side of that is if Tesla decides to launch its own fleet service, run all of the software itself, that would potentially cut out Mclan. Either way, I think the vertical integration of actually building the truck is going to be where the value is, and the hardest part is the autonomy. And if Tesla's building the autonomy, they're going to capture most of the value of that business. Therefore, we see a trucking logistics company at massive risk of maybe not dying, but of just declining, drastically shrinking margins in the wake of autonomous vehicles if they're not the one building them. Moving one step down on the income statement, we have railroads, utility, and energy. Approximately 47% of this is related to energy. 2/3 of your energy generation of the 30,000 megawatts that you produced in 2016 were related to coal and natural gas. So 1/3 was related to renewables, which is great. And I actually want to give Buffett a lot of credit for pushing renewables in his energy companies, although he's done it questionably with NV Energy in Nevada, kicking out Solar City. That's a whole nother story we can get into later. If you think that Tesla's solar roofs and their vision of a distributed energy system will take off, then that's going to pose an immediate threat to the entirety of your utility business, or at least compete with them to lower rates. Continuing in this railroad, utility, and energy segment of the income statement, the other approximately 53% of that line is from Burlington Northern, the railroad that Warren Buffett purchased. And we think this is a very interesting business, not only because Buffett acknowledged the risk that self-driving trucks will pose as a competitive threat, like dropping transport prices for cargo, making it way cheaper to transport things in trucks instead of rails, therefore driving a lot of the shipping volume into trucks out of Burlington Northern is going to be a big threat and potentially significantly impact the earnings of Burlington Northern.
Is autonomous technology more of an opportunity or more of a threat for the Burlington Northern?
Oh, I would say that the driverless trucks are a lot more of a threat than an opportunity to the Burlington Northern.
The other side of that is, what is Burlington Northern actually carrying on its railroad? A lot of coal, a lot of natural gas, a lot of oil, and a lot of chemicals. So there's a double whammy that's about to hit Burlington Northern, which is that A, self-driving trucks are going to make it way more competitive for cargo shipments. B, the renewable energy revolution that Tesla also happens to be leading is forcing the sustainable energy revolution is making all of these businesses that Buffett's shipping already less and less relevant by the day. Coal is getting less relevant, so is natural gas, so is oil, as solar and batteries continue to gain relevance in our energy system. If we sum this up, Geico is about 11% of Berkshire's revenue, Mclan is 21%, the energy business is about 7.5%, Burlington Northern is about 8.5%. In total, that's 47.5% of all of Berkshire Hathaway's annual revenue is at risk and seems to be losing relevance by the day based on Tesla's business model. We think this is a massive threat for Berkshire Hathaway as a whole. They're a very stable company with an incredibly safe balance sheet, so I'm not saying they're going to go out of business, but I think 47% of their revenue appears to be getting less relevant by the day, and they don't really have an answer to combat it. Great. We know this makes no sense as a typical Warren Buffett investment, but there are a couple things that Elon Musk and Buffett have in common that we think are worth noting. Both think incredibly long-term about the businesses they're running and have that mindset of not quarter-to-quarter Wall Street mentality. The other big piece of Buffett's strategy is to pick brilliant leaders and let them operate autonomously. There couldn't be a more perfect situation than Elon Musk. I think he hates people telling him what to do, so he'd never let someone buy Tesla, but he would love to have someone like Buffett is the perfect investor. He'll sit back, let Elon do what he wants to do, and give him enough capital to make it happen. And that's even the most important point of this whole thesis, is that Buffett could single-handedly almost turn this into a self-fulfilling prophecy. He had $49 billion in just cash sitting on Berkshire's balance sheet. That is more than 10 times enough to fund Tesla's development of their next 3 or 4 vehicles immediately. So also, this is kind of a side note, but there's a crazy rumor circulating that Tesla investors will actually have early access to a potential SpaceX IPO. This has the potential to be the most exciting IPO of the century, in my opinion, and if Buffett owns a significant piece of Tesla, he would get early access to this too. I'm not an investor, but as someone who would invest in Berkshire, I would want to see them start putting bets towards this future instead of just letting cash sit on their balance sheet. And the thing is, they don't need to put all of it to do it. Hear us out.
For something that has a moat around it for a considerable period of time. And I'm looking for an honest and able management to run it, because I don't know how to run it myself. And I'm looking for a purchase price that's not excessive. But it's better to pay a little too much for something that's a very good business than it is to buy some bargain, but really a company without much in the future. And
if I was Warren Buffett, here's how I would approach investing in Tesla. Immediately take a toe in the water position. The stock's at an all-time high, so I think buying a significant piece now doesn't really make sense, to be honest, and give it Buffett's strategy of patience, waiting for his time to strike. I think he would wait until a mega recession or some sort of dip in the economy happens to take advantage of a depression in Tesla's share price. But that being said, I do think there's an opportunity for him to buy 10 million shares at $300, putting another secondary offering out there, raising $3 billion for Tesla. They could immediately start building out the production line for this self-driving truck, accelerate all of the growth of their business lines, and have a big enough capital cushion to de-risk the business model. So we think it makes, as a Tesla investor, I'd love that. Then Warren Buffett therefore owns about 5 to 6% of Tesla as a whole. This investment, if Tesla reaches our valuation of $500 billion in 5 to 7 years, would be potentially a 10-bagger on his investment, hedging out most of the earnings risk that he's losing due to Tesla's business model succeeding. So it makes a lot of sense on that end. Second of all, if a recession hits, it would almost be a gift for Buffett, like he did with Goldman and B of A during the last recession. He allocates capital, gets in at a really cheap price, increases his stake in the company, provides them the backing they need to get through a tough financial time. So we think that he could do this with Tesla and take his 5% position now at 300 if Elon's down to let him raise the capital, and then wait for another recession. Maybe he could double his position if the stock gets cut in half for only $1.5 billion. Then he owns 10% of the company that we think is going to be worth $500 billion. So yes, Mr. Buffett, it already seems like you're interested and somewhat a believer in the electric car movement, given the $200 million plus you invested in the Chinese electric car manufacturer BYD. One thing that worries me that you're missing with that thesis is that there's two revolutions happening in the auto industry right now. Electric is just one, autonomous vehicles is the other, and I think that's a much bigger piece of the disruption. And you're not getting exposure to that through BYD, and that's why we think it makes a lot of sense to invest in Tesla as well. In terms of moat and building a defensible moat for decades to come, we think Tesla is leading the curve here. They're building a vertically integrated production facility, the Gigafactory, with the world's largest footprint that's going to be able to input raw materials, output futuristic self-driving cars. This is going to be a competitive advantage that no other automaker is going to have. They haven't even started trying to keep up with. They're trying to cut costs while Tesla's spending and innovating. And we think the business would be highly profitable if they stopped investing in growth. They have some of the highest gross margins in the auto industry already. They've ramped production out of nowhere. They seem to be incredibly capital efficient with the money they have raised. So we think that you should look at this not as a company burning incredible amounts of cash, but a company that simply has so much opportunity and demand for its vehicles, 500,000 Model 3 orders on the books. They simply need to invest to meet all this. You and Mr. Munger frequently talk about your greatest mistakes being ones of omission, missing out on upside of great companies and entrepreneurs. We think Tesla could be one of your greatest mistakes of omission, not just because you're missing out on one of the greatest brands being created in American history, but also because they're going to directly be a threat to at least 47.5% of your revenue by our calculations. So not only will you be missing out on the upside, but they're going to start competing and deteriorating your core earnings as well. That was a little harsh. Maybe we can keep that in. Because the one thing that convinced me about Tesla, talk to a Tesla customer, someone who's owned a vehicle or put a Powerwall or put solar roofs on their house, and ask them what they think the future of transport and energy look like and their connection with the Tesla brand versus all the other brands. And I think you'll begin to realize like the magnitude of what's happening here. I think Tesla is going to be one of the greatest American brands of the 21st century. We're still so early in this being created. Mr. Buffett, you've been an advocate of brands since day one. Coca-Cola has been like your staple investment. And so, I don't know, just don't miss out on the next great American brand. I guess that's kind of our pitch. And Tesla's building it. They're going to build a $500 billion company, maybe several trillion on their way after. So, last thing. We have a much more in-depth, comprehensive presentation about this that we would love to give you in person. It will only take 15 minutes. We will get our ass to Omaha. Let us know. My sister will loan me money for the flight. We'll make it happen. Also, there's no Tesla stores in Omaha. We looked it up. They have a service center. Don't go there. It's not going to be as cool as the store. Kansas City has a Tesla store. Check it out if you get the chance. Let us know what you think.
Jump in your caddy, get a couple Egg McMuffins.
Crack a cherry Coke, hit the Tesla store. Like, have you done that DD yet? Like, another thing is, we didn't have time to dive into a lot of the other smaller pieces of Warren Buffett's business, but he owns things like a financing arm that finances rail cars. I think about 110 auto dealerships, which we think is a totally legacy on the way out business that's being 100% disrupted by Tesla's retail store model, which is another reason you should do that, DD Buffett. But so that 47% number could actually be low, given the but you guys can do that DD yourself. We just wanted to highlight the biggest pieces.